Welcome to ABL Advisor's video series featuring executives from the commercial finance industry. I'm Michael Toggli, the publisher of ABL Advisor. Today, my guest is Joe Camberato. Joe is the CEO and founder of National Business Capital. Joe, it's nice to see you again. Thanks for joining me.
Yeah, it's always great to see you, Michael. How you doing?
I'm doing well, thank you. All right, well, today we're going to be talking a little bit about the preservation of equity and more specifically, junior debt versus equity rounds. I want to focus a little bit on the benefits for the borrower in choosing junior debt over bringing in private equity or mezzanine partners. Put together a few questions for you. If it's okay with you, Joe, I'll jump right into the questions.
Yeah, let's jump right in.
All right, good. Well, a lot of growing companies automatically think an equity raise when they hit a capital restraint or gap of some sort. Why do you believe junior debt is often a smarter option for preserving long-term enterprise value for the borrower?
Yeah, I think if your business is at a place where it's cash flowing and can support it, then if you can preserve that equity and continue to grow enterprise value, you can use debt and different types of debt vehicles to scale and grow. It's really something that you need to consider, and in the long run could be a lot less expensive.
Borrowers typically, the word is antsy about this equity play. Do you feel a lot of angst when they start to look at these opportunities?
I think that the market started shifting and is continuing to shift towards more people looking at private credit and debt and really understanding what non-bank lending is. Pre-COVID and even just a little post-COVID, private equity was really cool and sexy, and it had all this attention. And between shows like Shark Tank and everything going on in Silicon Valley and everything else, it was like the coolest thing in the world to announce that you did a private equity deal and a private equity round. And then I think, as that market started to tighten up, but also as, private credit and debt started to, some, companies were doing small deals. They started doing larger deals. Some of the larger, debt folks also started to do larger deals, right? So the markets really opened up, and I think everyone all of a sudden started to say, hey, wait a second, let me actually look at some debt. And I think too, we were in an environment where interest rates were so low. So when you looked at a debt deal compared to, knowing that, 3% money was out there, it looked really expensive. But then as things tightened up and private equity, groups started to get really aggressive in their terms, I think people started to look at, debt deals more. And, at the same time, cost of capital in general, just in a high interest rate environment. So, I think all that kind of spiraling together, I think just got people to take a step back for a second and say, maybe this is, something that we should consider.
Yeah. Yeah. So when commercial finance partners are advising clients, what are some of the signs that a company should pursue subordinated debt instead of giving up equity from your perspective?
Yeah, and we love working with with senior lenders. So we're happy if you have a senior lender in place, whether that's a bank or another type of senior non-bank lender. But I think if your business is cash flowing, if you're profitable, a lot of times what happens is with a senior lender, it's a function of AR and inventory and maybe some other type of collateral like real estate or something like that. And if your business is growing, everyone has their the formulas are very similar from senior lender to senior lender. Some will do more of an over advance than others. Some won't do any over advances at all in this environment. But we see a lot of companies out there that are profitable. They're great businesses. They're growing fast, and they have some sort of unique opportunity that they need to move quickly on. And they can't really tap into their senior lender for it because it's, they're not increasing their AR or their inventory or doing something that's going to, up what they're able to really advance against.
Yeah, it's interesting because it opens up the door for them to do something a little bit different without going to the senior lender, as you just mentioned. So National Business Capital really emphasizes preserving equity while completing the capital stack, to use the word capital stack here a little bit. Can you walk me through how that philosophy influences the way your team structures transactions?
Yeah, well, we're really great in being a bridge and growth. That's really why people use us. They have an opportunity. We work with folks in construction, contractors, all the blue trades, which can always be challenging with progress billing, in the typical ABL, world. So we love those deals, hospitality, medical, and then also like manufacturing, wholesale distribution. When we look at these deals, typically these companies have, if it's in construction, they've got the ability to move to another job, but they're waiting to get paid. So in that situation, there's no reason to sell equity. Like, business is good. You've got another opportunity to take on more work and to grow the business, while you're waiting to get paid from a last job that you've completed. Or maybe have an opportunity to buy, inventory to discount or do something of that nature if you're in, wholesale distribution. Those situations, there's no reason to give up equity at that. You've got a growth opportunity It makes complete sense. And there's just other, there's other options out there that I think have to really be looked at and considered.
Joe, I'm curious, when you and your team are out there educating the borrowers on some of their options that they can be taking, are some of them really not familiar with the tools of junior debt, subordinated debt? Is it a surprise to them that they have this opportunity to do that sort of financing, take advantage of it?
Yeah, that's a really great question, Michael. And actually, it continues to amaze me that so not only do borrowers, business owners, CEOs don't understand the capital stack, we
Mm.
also talk with great people that have been in the industry, advisors, investment bankers, other ABL lenders, banks that don't realize that, hey, we can go up to 10, $15 million in a junior subordinated, position in sub debt without taking equity or collateral, and we can move very quickly. Again, the world of financing is constantly evolving and changing. And our focus and what we've done has changed rapidly. Most people don't realize it. And most businesses that we work with great companies, decent sized companies, large, small businesses, lower middle market companies. Most of those CEOs and founders are really great at what they do, but they just don't understand how the world of financing works, whether it's banking, whether it's ABL or other type of lending. And you really only know what you know, right? And if you don't get connected with the right advisor or speak with someone, it's a very confusing world to navigate through, in general. So we take our time to educate borrowers, talk through where they really sit in the capital stack, whether or not a senior lender, asset-based lender makes sense for them, why they're going to get what they're looking for or not get what they're looking for, what the alternatives are, and then trying to really piece it all together. And I think we're seeing some of the best companies today are the ones that are really understanding the capital stack. And there's usually one or more lender in play. And they might even have some like a private equity partner in the mix. And we work with a lot of private equity backed companies where there's private equity, there is a senior lender, whether it's a bank or non-bank lender. And then we're working with those folks as well. And maybe they've even raised some private, debt on their own from friends and family. And that's another interesting thing that people are doing in today's market is they're raising private debt versus equity, as well too.
And that's always going to be happening out there. You work with referral partners and ABL lenders regularly. And the old saying used to be the most expensive thing to do is bring on a customer. You don't want to lose them. And it's just the proposition we're all facing all the time. So when you're working with the referral partners and the ABL lenders, how can junior debt become a tool for them to actually strengthen their client relationships rather than losing them to private equity firms? They got to be afraid to lose them. I mean, this is a way to strengthen it, correct?
Yeah, it definitely is. I mean, ABL folks love working with us. We're happy to work out an intercredit agreement and work through those. Some ABL lenders, we have a master intercreditor agreement in place, so we can just move when it comes to a deal. But what they love about that is they can come to us and, it avoids their client from going out there shopping. And when clients are out there shopping, a few things can happen. One is it's a extremely competitive market, whether it's banking and ABL. And some folks, if they're in banking, will do whatever they need to do to get those deposits. And that includes a potential over advance. And the same thing with ABL folks, like, if it's a clean, great deal, people want to win that business. And it's hard to find great deals in this market. So it's super competitive. So we really take the competition, off the table. They can retain that client. We can work with them. We share in what we're doing as far as terms and get everyone comfortable. And if they're not comfortable, we can reduce, our funding size or do nothing, So we're super transparent. We look at, everyone as a partner, and we want to be transparent in what we're doing, and we want everyone to be all on the same page. But what also happens in those situations is, we had a deal, great business. They had an opportunity to take on a very well-known company, a cell phone brand. They manufacture something, for phones, and they had the ability to take on a big new contract, which was going to require opening up a new facility. That facility required equipment, working capital, and a number of things. Currently, in order to open up that new facility, they were tapped on their ABL line. And really what they needed to do to open that facility, build out and stuff like that, none of that stuff was going to really, they couldn't use their current ABL line for. So we came in, junior debt deal, I think it was like $1.5 million, $2 million. We gave them the money to go and open up that whole facility, get up and running, and take on and fulfill that contract. But then what happened is that increased their AR and their inventory, which now gave them the ability to advance more on their ABL line. So it really was a win-win for everybody. They took us out in like 12 months. So we were done. We were out of the deal. and they completely sized up their ABL facility, increased the revenue and profit to the business. It was a win-win for everybody: the business owner, the CEO, the other ABL lender, and us. And we love those win-win situations.
That's interesting. So let's use that example for a second because I like that one. Let's just say that company went through this, very successful, take you out in a year. Do they come back sometimes? It happens again in a year and a half. Good experience. Do you see them come back?
Absolutely. I mean, typically like half of our business monthly is repeat customers that come back to us. We have a lot of, like I said, like growing opportunistic companies. There's a lot of acquisitions out there today. There's unique opportunities out there. So when folks come across some of those growth opportunities, they'll come to us. If they're growing fast or they just need a bridge to get through, a cash flow, period, they'll come back to us. Some folks have like big buying dates, throughout the year. Like, once a year they do a big inventory purchase, or they're getting ready for the holiday season, or they're opening up a new facility, whatever it is. Those folks as needed, come back to us, and we love working with them. And once we have that relationship in place, and especially with good history, we can move even faster, on the second time or third time around.
Yeah, it's great for the borrower, great for the lender, and great for you. It's truly a win-win in that situation. So you mentioned a little bit how competitive the marketplace is. We've got private credits expanding in the marketplace, alternative lending's everywhere. There's more money accessible than ever out there today.
Yeah.
When you look ahead, do you see businesses, with all that in mind, do you see businesses and the owners of those businesses becoming much more protective of equity than they used to be? Is there a shift going on?
Yeah, I think that shift, excuse me, it's already started. And it's been happening. And there is this whole shift now to looking at private credit debt in a completely different way and using it as a tool to scale and grow the business. Also, too, the private equity market has been tighter than it's ever been. Terms have changed. And private equity folks are looking at more than ever, like, what's my yield going to be on an annual basis? Am I getting distributions and dividends? What's the exit strategy? And if that stuff's not clear, you're not getting an offer, or the terms are going to be non-favorable. And I think as the markets continue to change, I think as business grows, and I think with all this capital out there, I think it's something that you have to look at, and I don't think it's not going anywhere. It's only continuing to.
Yeah, there's a new fund out there every day with more billions in it. That's just the way it is today. Well, Joel, I covered everything I wanted to cover today. Is there anything I left out that you wanted me to ask that we want to talk about today?
I think just to follow up to what you just asked, what's really interesting, I founded the company in 2007. And in that time, access to capital was not as, there wasn't, it was much harder. There weren't as many choices as there are today. And it was still challenging because you didn't know where to go. And back then, when I got started, a lot of lenders didn't even have like websites. There wasn't a lot of information online. So you really had to work with a good advisor. But now fast forward to today, like as you just said, Michael, there's a lot of money out there, and there's all these different avenues, which it actually almost makes it even more confusing. So I just think from just, as an advisor out there, or as a client, a business owner, it's really important that you know who you're working with, and that you're working with, an advisor and someone that can really educate you and help you navigate through this world, because there's almost too many options. You can get really inundated. And like in every industry, there's good companies out there and there's not good companies, right? So you don't want to work with a company that is in like a loan to own type of strategy. So, you want to make sure that you work with the right company. You want to do your due diligence, your background checks, and just know who you're getting into bed with. And that's on the private equity side, or, obviously on the debt side.
Very interesting, Joe. It really is. Well, thanks again for being here. I enjoy the conversations. I'm sure we're going to be talking to you again, and best of luck for the rest of this year. I know you're having a good year again, and we'll be talking with you soon.
Thanks, Michael. Same to you. Have a great rest of the year. Thank you.